Okay, and welcome back, students who are taking math for business and finance and math applications. Excuse me, we're continuing on with our chapter 17 on depreciation, the theory videos. And in this video, and actually it's going to end up being 2 videos instead of just 1, because I actually created another video and found out that I needed to make 2 videos. Okay, so I scratched the other one, and I'm going to just start all over again here, and we're going to be covering our declining balance, okay, or also known as double declining balance. Now, declining balance is a deviation from straight line and units of production. It's not, even though our schedule of depreciation is similar, okay, meaning, I mean, if you look at the other charts, the other schedules, we had a end of year, we had a cost, we had a depreciation amount for the year, we had an accumulated depreciation, and a book value of depreciation. For our declining balance, we actually have to add a couple of columns, our accumulated depreciation at the beginning of the year and our book value at the beginning of the year. Okay, so these other these other 2 columns here, let me do this. This accumulated depreciation and this book value is for the beginning of the year, and these 2 are for the end of the year. Okay. The way we do the math on the schedule is pretty much the same. Well, not the same. I mean, calculating our depreciation, yes, we will calculate a depreciation, and that's where the difference in this method comes. And whatever we get for the depreciation, you know, that'll create our accumulated depreciation, which will then be subtracted from the book value to give us our book value for the end of the year. But I'm jumping ahead and with that, without explaining some of the other basics. But the point here behind using this declining balance method is that when we use straight line, okay, we calculate a depreciation amount. Depreciation amount, oh boy, AMT. And whatever that amount was, and let's say $400, it was going to stay the same for the life of the useful life of the asset. And with units of production, we went and we determined how many units the the asset would produce over, you know, the same number of years. And so even though the units would, you know, if it said like it would produce 4,000 units, and over the course of 4 years that would be like 1,000 units per year, right? You know, it didn't necessarily mean that's like an average, all right? So we calculated a per unit cost, and we applied that against each year. So each year you'd be approximately 1,000. So one year it might be a little bit less, next year might be a little bit more than 1,000, next year might be the same, might be above, might be below. It all depends, okay? But for the most part, it stays, the general amount of depreciation would stay the same over the course of the useful life. With the declining balance method, that's not happening, and this is a big deviation from straight line and units of production. Declining balance now has its own method, but also the same kind of thinking will apply towards using the makers, okay, which will be the topic of, you know, another video, okay? But the same thought process will go into that. Now, the purpose behind using the declining balance method is, instead of keeping my depreciation the same each and every year, what we want is, we want to be able to take the most amount of depreciation in the first year and then have it decline over the years. So so we take the most in the first year and the least, you know, towards the end of the useful life. Okay? And in order to do that, we have to calculate a rate. Now, the way we calculate the rate is we take 100% and we divide it by the years in useful life, right? and that will give us a percentage, and then we multiply that percentage by a rate or a factor. In this this factor, the greatest it can be is 2. Okay. Now you can choose anything else you want. You can choose 1.0, you could use 107, you can use 125, 175, 197. You could choose whatever you want, but the most is going to be 2, right? Now, the other, I mean, obviously you're not going to choose 107 or 197, okay? But if you have your own, what you're talking about is an acceleration of the depreciation in the beginning year. So, as an example here, and let's just do the math, so you can see what I mean by the acceleration of it. If I have 100%, and let's say I'm depreciating it over 5 years, that's 20%. Now, if I multiply that by, say, 1.5, okay, that's going to give me 30%. That rate, that 30%, is what I would use to multiply my book value each and every year. Now let's take a different scenario, and let's take 100%, and we're still going to use the 5 years, okay, which gives me 20%, but instead of 1.5, we're going to use the maximum of 2, right? Well, that means we're depreciating 40%, right? We're depreciating the book value by 40% each and every year. And this example is using the factor of 2, which gives us the rate of 40%. Right? Obviously, if you have $1,000 and you multiply it by 30%, you get 300, right? And if I had 1,000 again, and I'm multiplying it by 40%, I get 400, right? So now you can see why using the different factors creates a different amount of depreciation. And by using 2, which is the greatest amount, at 40%, you're taking the most amount of depreciation. Any factor less than 2, you're going to have less an amount of depreciation, but you're still going to be working from the perspective of the greatest amount in year 1 down to the least amount at the end of the useful life. So that's kind of like the theory and concept of it. And what does that do for you? Well, obviously, if you know that this year is you're going to have a huge profit, and you're trying to find ways to create expenses, depreciation is a phantom expense that allows, if I could take more of a depreciation this year, and what I mean by phantom is that you're making up that number, all right? Whereas if you buy, if you have a utility expense, that's a hard amount. Or let's say you have to buy a tool, that's a hard number. You can't play with that. Okay, when you're choosing your depreciation expense, you're able to figure out which one to use in your best light. And then if you have a large amount of income and you want to offset that income with your expenses, you would want to choose a method that allows you to take the most amount of depreciation in that first year to offset that huge amount of income that you have, so that you don't have to pay as much in taxes. Okay? And because the greatest factor that you can take is 2, okay, quite often, you're using this method so that you can take the most amount of depreciation. Okay. And if that's the purpose behind you using this method, if that's the reason why you're choosing this method, well, then it makes sense for you to take and use that factor of 2 so that you can depreciate by 40%, the most that you possibly can. And because you're using the 2, it's often called double declining balance. All right. So even though we use the term declining balance. Declining balance, you have to look to see what that factor is, whether it's 1.5 or 175 or even 2. But why would you really use 1.5 and 175 unless you want to have, you want to be able to take more than, something like straight line, okay? But you don't want to take the most. It all depends upon, the situation. It allows for variability, allows for a little bit of a different look at things, and you have to figure out, what you're going to be comfortable with, and that's what the accountants do. But in choosing the declining balance, most often the reason why they choose it is because they want to take the maximum amount of depreciation expense in the first year, and because they're taking they want to take the most amount of depreciation in the first year, they use the factor of 2, and they just generally call it double declining balance. When I see double declining balance, I kind of automatically assume that I used that factor of 2. Okay? So, real quick, the most important thing to remember here, and I will stop the video and then I'll explain the schedule of depreciation, is that we're going to take 100%, that's a given, and then we're going to divide by whatever number of years we decide for a useful life. Okay. Let's say I use 10 as my useful life. Okay, so that means I would have 10%, and then I'm going to multiply by whatever factor I want. Well, again, in using the declining balance, most often we use 2 because you want to take the most amount of expense, and that means we would use a rate of 20% each and every year. If I had that same 10% and I decided to use a factor of 1.5, that means I would use 15% each and every year. The amount that the most amount I'd be able to, the most depreciation expense that I get in that first year would be 20%. Any factor that's less than the 2 means I'm going to get a lower amount than of depreciation expense than if I had used the double declining balance method. In other words, using the factor of 2. But you're going to use those rates, like in the case of this example here, 40% every single year, okay, because you determine that rate up front. All right, so I'm going to stop here. If you don't understand something, I'm going to tell you to watch the next video, and then maybe it'll make it clear. But then if you still don't get it and you've watched them both a couple of times, then telephone and speak with an instructor, because the thought process here is a little convoluted, but it's the same kind of math intensive. So I'm going to stop here and go in the next video to finish off, looking at this depreciation schedule, and then looking at the depreciation schedule, the math will come together and it may make more sense. Okay.